You know, I got to tell you, I mean, WTI crude has been caught in a range between about 45 and 55 for what seems like months. I mean, what's it going to take to break us out of this range?
Yeah, it's nearly 10 to 11% below or nearly 17 months high that we saw earlier this year in January for both Brent and WTI. As you just alluded to, the fact that, OPEC is cutting. The compliance has been remarkably good since the start of this year. However, an emerging issue with that in the minds of the market participants is that, let's say, the 1.2 to 1.3 million barrels per day that is being removed by the 11 members of OPEC that are party to the agreement is that being offset, by Libya and Nigeria. Both of the countries are exempt from the agreement, and their production is creeping up, or rather, rising rather remarkably. The other major question in the minds of the market participants is, of course, U.S. production. And last week, I think the EIA delivered another jolt to the bulls, rather, by revising up its estimates for production growth this year as well as next year. So now it's forecasting nearly 430,000 barrels per day increase in average U.S. production this year. And I think the concern for those looking for a market rebalancing is that it might rise even more.
And there's a lot of, I guess, mixed signals out there as well, isn't there, Vandana? Because about 2 weeks ago, we saw that big plunge coming through in the Asian session around midday when oil suddenly plummeted to its lowest levels since November on the WTI contract. It did manage to rebound, but, there's, on the one hand, as you say, the US supply concerns, and then there's the OPEC cuts, and a lot of people in the market just can't seem to work out what's what.
Yeah, some of that plunge, and I was watching the screens very closely and quite surprised, actually. We haven't seen intraday volatility of that kind for a long time. And some of that was attributed to technical selling, panic selling, and it subsided, of course. Crude has been relatively more stable since then. But I think the fear remains, aside from these slightly longer-term factors that we just discussed. On a week-to-week basis, I think what is lending a lot of volatility is what the U.S. stocks, especially gasoline stocks, have been doing and what U.S. gasoline consumption is doing. And I think a major relief for the market last week was a rather surprising uptick in gasoline consumption on a weekly basis in the U.S. So I think going forward this week, OPEC, more or less, OPEC's decision is already baked into the market. I don't see any surprises there. All eyes are now going to be on U.S. data in terms of stocks and gasoline consumption.
So do you think there is much risk of us breaking through, or the market breaking through $45 on WTI? And do you have a sense of whether or not a price below that level would create credit disruptions in the high yield market? These particularly U.S. shale companies that are counting on higher prices, and if we were to see something, let's say, south of 45, that it may start to call or create a little bit of credit risk?
So as long as OPEC is determined to roll over its cuts, and I do believe they are, OPEC as well as non-OPEC, and equally I think they're going to ensure that there is a high degree of compliance, I don't see a danger. Basically, that's putting a floor. It had earlier injected a lot of premium into crude over December and Jan, but increasingly that's just putting the floor. So to answer your question directly, I don't personally see a risk of WTI slipping below 45 and staying there for a sustained period just simply because of the cuts. However, I think what the stocks shape up as, especially in the U.S. and the OECD, that's what the market is looking for, evidence that the cuts are working. And it's highly unpredictable. If we see a week of, another jump in stocks, crude, gasoline stocks in the U.S. and elsewhere, and we see a drop in gasoline consumption, yes, that could push WTI below the 45 level again. Longer term, I completely, as you hit the nail on the head, basically low oil prices are going to curb low oil prices, essentially. So at sub $45, what for sure it's going to have an impact on U.S. shale production because it's very price sensitive, right? But right now I don't basically see that happening until OPEC is maintaining its cuts.
And to play devil's advocate to that as well, of course, we're going to be heading into summer, into the US driving season. At what point is it likely that we get anywhere near where we saw crude oil, say, in 2013-14 when it was above $100?
Never.
Never. Not happening again.
It's not happening again. It's my focus is on day to day and more short term, medium term oil markets. But one cannot help but look a little farther out into the distance. And you read about all the developments in EVs. China and India, placing aggressive targets on electric vehicles or renewables. I think, looking into my crystal ball, the future is probably shared public electric vehicles rather than personal gasoline cars. So, of course, I'm looking a little farther into the distance. But, is that going to happen in 5 years, 10 years? Who knows? A disruptive technology could bring it far sooner than most of the oil industry is expecting.